Welcome, everyone. And yeah, today we are talking about the proliferation of stablecoin models. Certainly a hot topic in the space right now. But before we get into it, I guess we could just begin with some introductions going left to right here. Who you are and what you do and the work related to stablecoins. Diogo?
Yeah, I'll start. I'm a co-founder and executive chairman of a company called Anchorage Digital, the first and still only federally chartered bank. We have over $50 billion of assets on the platform and clients like BlackRock. I'm also the general partner at Haun Ventures. We have a $500 million early stage fund and a $1 billion growth stage fund focused on crypto. And I'm also the chairman of the Norair Foundation.
Hi, my name is Baek Kim from Hashed. We've been around for about 8 years doing early stage venture in crypto space. We also operate a few operating companies within the blockchain space. So we have a Korean version of Anchorage, which we started about 5 years ago, called Coda. Manages about 14 billion assets under custody. It's a dominant player in Asia. And we're working on some of the stablecoin initiative along with that as well.
Hey. My name is Tony. I'm CTO of M0 Labs. Joined M0 2 years ago, and we built a protocol for issuance of stablecoins. Before that, I was also in Compound Labs, like the same as previous speaker, and also started my blockchain journey from Consensus. Really excited to be here.
Thank you. So to begin, let's kind of do a little sentiment check on our thoughts on the stablecoin market. Total supply just passed 250 billion, growing 60% year over year. Genius Act just passed the Senate. Treasury Department is bull posting stables to 2 to 4 trillion. And we're getting headlines like JPM and Bank of America are entering the market. So yeah, let's check the sentiment. How are you all feeling about the market? What is your level of optimism and conviction in the stablecoin space?
I'll start. I'll just say that I guess my opinion doesn't really matter, because the only thing you need to know if the market is excited about this or not is look at the revenue multiple from Circle on the public market. And you should look at it right now because it's pretty exciting. The market is very excited. And so it doesn't really matter what we think. I think we're at all-time high excitements, all-time high issuance, and a lot of irrationality and irrational excitement or irrational exuberance. So there's definitely a lot of that right now.
Yeah, from a venture investor perspective, as Diego said, it's very overheated, I'll say. I think people here who's been in the industry for a while, we knew the importance of stablecoin, how utilitarian it is, and how we can use for a lot of different verticals. But now it's really working out and waking institutions and other players in the different industry to join and utilize this. So we've been seeing so many early stage new companies in this category of stablecoin payment, and infrastructure. So I'm curious how this will lead to basically fundamentally different infrastructure that's different from what we have in stablecoin in the next 5 years, rather than more stablecoin, more number. I think the number will continue to go up, just like how we think about market cap of crypto. But where do we go from here, rather than just talking about growth number, it would be very important for the industry.
From engineering perspective, we see a lot of work, especially recently. It's like becoming very hyped, very hot industry. And everyone wants, like a lot of projects want to build their own stable coins, which get back to me and my team. And we're working on frameworks to be able to build stable coins for our partners as fast as possible and make it custom programmable yield, compliance check, and all kind of baked in things. So it's been busy, and we expect that it will stay this way. The sector is growing really fast. It's also the question of chains, right? So we have EVM, like Ethereum mainnet, obviously L2s. We have a lot of interest on Solana, Sui. All of these chains have their specific use cases, and stable coins are hot on all of them. So yeah, it's like basically for engineering, it's a lot of work. And we are hiring. If anyone is interested, please reach out.
So the current stablecoin market is 90% the fiat-backed model, Circle and Tether. But we also have this long tail in the design space, whether it's more like tokenized treasuries, or CDP like DAI, Go, Bold, and then also delta neutral strategies like Athena. So I'm curious where you think, out of those line items, which stablecoin type do you think will exhibit the most growth, and what role does each of those types of instruments play in the overall stablecoin market?
Yeah, I can jump in and start. It's extremely hard right now to bet against fiat-backed stablecoins. Historically, they've been the dominant player. Nothing indicates they're growing faster than every other stablecoin, and there's no stopping it. And in fact, it would make a lot of sense because the majority of traditional flows, whether they're remittances or pay-ins or payouts that are happening in traditional financial world, this is a perfect one-to-one replacement. And from a risk perspective, it's extremely easy for a compliance team to understand that stablecoins are actually, in a certain way, narrow banks. A stablecoin is safer from a credit risk perspective than an actual deposit at a traditional commercial bank. So from the point of view, if the dollars are held at a GSIB, a systemically important bank, and they're backed by T-bills, and you have a reasonable treasury model, then all of a sudden this is a no-brainer for you to replace one thing, which is a fiat system that is slow and non-programmable, with a much better programmable system that is global, and it's actually safer from a risk credit perspective. So my expectation is that we have a huge room to grow on the fiat side, and that is going to be the first thing that institutions are going to adopt. And I think, that's a trivial statement because it seems to be what's happening, and the data definitely backs that. However, I think CDPs and delta neutral strategies like Athena are actually fascinating developments of the space, and will be much larger in the future than right now. They're just suffering from, obviously, the downfall of Luna and Terra. They sound similar. They're weird instruments. People have to think about what the credit risk is. They do have counterparty risk to exchanges, because on the exchanges lives the derivative that actually is backing the delta neutral strategy. So there's more hair on it. It's a harder one to introspect, but it's extremely exciting, and I do think I'm very bullish on the future for us to have the whole segment mapped out. However, how does it end? Is it 80-20, where 80% will always be fiat-backed and 20% will be some version of truly decentralized stablecoins? Maybe, but I know that the market won't be $250 billion of issuance. It will be tens of trillions of dollars of issuance. And so even the 20% of tens of trillions of dollars will be extremely, extremely large, and much, much larger than what we have right now.
Yeah, I think that obviously the pie is growing, and the pieces of pie will grow. Most likely, like my prediction, proportion will stay the same. So we'll see increase of fiat-backed, also treasury tokenized-backed stablecoins. The model CDP recently was listening to our plan, and they looking to grow gold to 1 billion this year. So to grow it 5 times, because it's very capital efficient for them, and like a lot of their revenue coming from it. So CDPs probably will grow as well, but proportionally, I think it's most likely will stay the same. The same for delta neutral stable coins, like obviously led by Athena. They reached significant market cap, like how far they can go from now, probably like a couple more billions, we'll see. On the other side, I want to say that we see a different model, which actually M0, like the company I'm working for, kickstarted. We build an application-specific stablecoins. And now every application can issue their own stablecoin, and we see a lot of interest of that. So customization, I think, of stablecoins will be a thing, and we are growing, like we'll continue to grow as well.
Yeah, for me, fiat-backed stablecoins are kind of like a good student, textbook smart. It does all the things that are required by institution and what we think is good. And a lot of other long-tail stablecoins that Luke mentioned are kind of like a super smart, genius student, but doesn't really show up to classes, and we don't know what's going on, but they come back with crazy ideas. And those are the things that push the boundary and really push the innovation. But we need both worlds. And for the fiat side, it's very obvious. We need it. It's going to continue to grow, and it will be served in a versatile manner. I think for CDP or other like kind of hedge fund like products, which our funds have invested before, needs to be more purpose specific. The bar to launch stablecoin will continue to go up, not in terms of a technical way, because it's getting much easier with teams like M0 and others providing all the infra, but in a more economic size way to be relevant. You can launch anytime, like launching meme coin, but to be relevant on top, utilize high market cap stablecoin, the bar is going to continuously go up as the market cap go up. So how do you compete in that market? How do you even do marketing for your stablecoin, right? Because stablecoin has no tech difference usually, so it's all about marketing and distribution. How do you build that? When there's incumbents that will continue to grow at faster rate. So for this kind of long tail or challenger stablecoin, they gotta come with very specific niche, narrow go-to-market, whether that's RWA or other micro regions that they target that's not served. So I think we'll see very creative round setup of a stablecoin than what we have now, which seems like it's dominated by USDT and USDC.
I'll just say one thing, which is the pretty obvious weakness of Genius Act stablecoins, and I'm just going to use Genius Act as a general moniker for anything that has over 90% backing by one-to-one dollar in a GSIB account or a T-bill. But the biggest weakness of Genius Act stablecoins are clearly the fact that definitionally, by the law, they can't share yield. And if they can't share yield, they're a much worse product than something that natively shares yield with a consumer. And herein lies tons of opportunity for entrepreneurs, and I think Athena is a good example of something taking advantage of this arbitrage, which is a regulatory arbitrage, let's be candid, but it is a Genius Act stablecoin, does not have the ability of sharing yields. And now you can say, okay, but there's all of these RWAs that actually wrap T-bills, that can sort of like be an equivalent, but those are already securities and classified as securities, and the access to a security in the United States, it's much harder. And so we also have to consider the fact that there's an international market. And these would be kind of like the obvious weaknesses that I would say. That's why there's still going to be a lot of innovation, because Genius Act stablecoins can't do yield.
That's great. I want to touch on one of Baek's points, then go straight into the Genius Act. So as we see like new entrants come into the market and the bar that they need to hit to become relevant, as you said, Baek, like how can these new entrants reasonably compete to stay relevant, like through what vectors, whether it's liquidity, yield, distribution, like what's the most promising avenue for a new entrant to get their foot in the door in the market?
I guess liquidity really is hard to compete with USDC, USDT, which dominate the market, like as a new stablecoin entrant, and like to match on-chain liquidity of these coins is really hard. Then we can compete, obviously, like we'll discuss the yield and programmability of yield and like Genius Act and what to do with it, but also like customization and being able to provide distribution players. Now, like every application can be distribution, like their own features, which they need, and like their compliance checks, which they need, which is not built in USDC or USDT is a big thing. So it's basically, in some way, we have to be better. So like be better via yield, be better via programmability, or like just working with distribution partners in more transparent way.
I don't know, I would just say that the obvious one is regulation, which is we don't know how central banks and regulators of many of these countries are going to react to 50% of their economy starting to happen in a stablecoin that is dominated in dollar. Do you know how Nigeria is going to act whenever that's the case? Whenever there's a market of a self-custodial wallet that every one of your citizens have, and they just start transacting in what they want to transact in, which is a currency that is actually not hyperinflating and for which there's no capital controls because you're doing so on a decentralized system. We don't know how they're going to act. So many of these, we also don't know, for example, how a US-issued Genius Act stablecoins is going to be perceived by Singapore. Will Singapore just allow all of their citizens to have this and operate with this, or will they force the companies to repatriate some of the T-bills to a local company and have some kind of a split so they can actually tax revenue on a company in Singapore? Who knows? So this is going to be one of the biggest pieces that is unknown right now. $250 billion of issuance is not big enough for us to tackle this problem as a regulator, but once it becomes trillions of dollars and this becomes a dominant force or form of cross-border transactions, then all of a sudden the tune is going to change really quickly. And as we've seen, the growth of these things is extremely explosive. So I think this is actually the biggest entry point. And it's not a good entry point, or maybe it's a good entry point, but if somebody in Singapore has an in because they're a Singaporean company and they're really friendly with MAS and they're local citizens, then maybe they have a wedge, same thing in Hong Kong, to actually create a company that captures significant value because the government forces these stablecoins by the local companies and by the local consumers to be a stablecoin that is a dollar-denominated stablecoin but issued locally. So this is one of the biggest ones. In general, though, I would say that you should not be starting a stablecoin. The people that are going to start stablecoins that are going to be successful are people that already have distribution. It's going to be, I don't know, a Revolut or a Robinhood or a Stripe or any company, especially like the folks in Brazil that already have massive distribution and have side-by-side the local market wanting stablecoins, and they have hundreds of millions of consumers. Those are the obvious people that are going to put a stablecoin in front of their consumers and have it work. The idea that a startup can just come with like a yield-bearing stablecoin and beat someone that has hundreds of millions of consumers, it's kind of ridiculous. And I would even say that the banks are coming after this pretty hardcore because they don't want to lose the deposit base, and so they're going to try to do this. In fact, I think the final thing that I would say is that we're going to talk about the Genius Act, but it's very likely that the biggest constituency that pushed back against Genius Act stablecoins being able to have yields was the banks, because the banks did not want to lose that high ground.
Genius Act. 2 weeks ago, Senate passed it. Seems like it lays a red carpet for TradFi issuers to enter the space. So how are you all evaluating the impact of this bill, both on the US market, but then how does it leave open the design space for players on the international market?
Yeah, I think Diogo gave a good kind of a teaser into international impact as well. Like the stablecoins that are coming out in a USD basis is bringing, as Diogo said, neobank-like effect to a lot of the fintech players. And fintech has been successful and been a very hot topic in US and globally, especially in emerging markets, to remove friction and give access to more people and better financial product, financial freedom. But it was shallow kind of layer of a wrapper for most of the countries and most of the application. They couldn't really be a bank themselves, and they were actually impacted when things like SBB or like a First Republic Bank or a lot of these kind of banks behind the neobanks have failed. They couldn't really have a control around on and off ramp, or their services just completely stopped. And stablecoin, I think, brings interesting option for them to actually become more of a deeper stack as a provider and have a more flexibility in having their own services. And it's also interesting for like a pay as well, not just like because stablecoin pay is more efficient, but there's already giant volume of a pay provider like Google Pay, Samsung Pay, Apple Pay, and a lot of the pay across different regions. They're also a very small layer, like they're big volume distribution, but very thin layer on top of their platform, and they create so much GMV. But with their own stablecoin, they can actually start adding different services on top. So the whole kind of offering of these big distributor will completely change this offering, and also USD becoming much easier for non-US company services to access that will also completely change it. And I think it's a concern for a lot of international economies, because in US we're used to USD being free flowing like euro and yen, but those are only few currencies that are free flowing for foreign exchange. Most of the Asian countries, most of the countries across the world have very strict capital inflow, outflow regulation and foreign exchange, because they don't want their currency exchange rate to get destroyed by a certain event because of a certain PE coming in or a certain trading activity. So there's always a friction point, but crypto kind of removes that or create a loophole. So how they react with that? How do they react with their own domestic currencies against USD? Because right now it's already happening where, as last few months, there was so much focus around USD that all other assets, currencies were getting devalued. There was so much effort to go to USD from other assets, especially from Asia and Africa and others. How do we, I don't know, prevent that if you're a government, or do we need to prevent that, right? So it actually brings power to be so efficient and concentrated that you have to think about other issues that usually government could be comfortable about, or even service providers could be comfortable about, but now you have to think bigger picture in a more of a global economy, money flow, rather than kind of insulate your own market.
Well, one thing that I would say is that this thing is not signed yet. And in fact, not only is not signed yet, it's not on the president's desk, and it's not about to be signed. And there's politics being played by people in the industry that are trying to tie the Genius Act with the Clarity Act and trying to pass them as a bundle. So we might actually take defeat out of the jaws of victory yet. And so there's politics being played. This is not a done deal. So I would just say pass the thing, sign the thing, and then I'm happy to be on stage actually like claiming victory. But right now, there's nothing, right? This hasn't been signed into law.
Yeah, I also want to add, first of all, yeah, Genius Act, it's US, and it's like US, there's a whole world also outside of US, which is just interested to hold digital dollars. From my perspective, from engineering perspective, I think rewards or yield, which can go down, will still find its way to the end user. It's just like token models will change. So what we see, like with our company, that partners interested, for example, to build the token where all yield is distributed back to them, and then this yield is getting to the user in form of rewards, points. Like users have to additionally stake their token, which didn't have a yield, into like the vault, so it's like staking vault, and then can receive additional points from that, and then eventually this yield can get in that way. So I think no matter the act, like the user has, like, stablecoin space is growing and everyone is competing, and to compete effectively, like the end user needs to get something. And now it's just only a question in what shape and form this end user gets it, and how it affects our token models. But it's one way or the other will pass what we have.
Let me just say one thing, which is generally us Americans have a very inflated sense of self, and we only think about the United States. In this particular case, we're right. 99.9% of stablecoins are US-based stablecoins, which means that there's a dollar in some bank somewhere that is regulated by us. So that's really the only thing that matters.
How can we build a stablecoin model that can return a durable risk premium or yield to the holders in excess of the risk-free rate? Or is this something that doesn't need to be done and a 30-day T-bill rate is good enough?
It's just going to be a different financial product. You just can't call it a stablecoin. That's it. So I'm fine with all of it. I'm fine with the gradation. I want 1,000 flowers blooming. I want all of the products out on the risk spectrum that everybody does. You just have to be extremely clear on what is the risk that you're taking and what you're delivering to me. And if you do so, please do basis trade. I love it. Athena is awesome conceptually. Just we can't call it a stablecoin. It has to be very clear what I'm getting.
Yeah, I definitely agree. We are investor in Athena, and we see so many other kind of yield-bearing stablecoins and other ones that generate return for investor. But I think of these as also a financial product, almost like a fund with a different set of liquidity than what we've seen before in a traditional fund structure. Now people can actually get whatever your goal is, whatever your risk profile is, whatever your return profile is, there will be something like stablecoin that give you that in a form of a dollar-denominated manner, which is attractive for many of the economies or family offices or funds that are looking for that risk profile to compose your portfolio. So I think the definition of stablecoin will continue to evolve, but I think when we talk about payment, utility, all these, it's more of a fiat stablecoin nowadays, but a lot of these CDP or RWA or other yield-bearing stablecoin, I think it becomes more of a specific product with the purpose to make a specific group of investors happy, but it might not be a good fit for you just because yield is higher than what you're using today. So it's like choosing your financial product with your own choice, with your own custody, which is very new experience for many of the investors globally.
Yeah, just to add to that, obviously we cannot do durable and without additional risk. So this is just by definition about risk curve and reward and risk. I just want to mention that right now it's very nice that we have two sources of native yield. One, if we think about off-chain collateral treasury bills, tokenized treasury bills, which give you the closest risk-free rate. And the protocols can take it as a foundation and just assume, okay, this is my risk-free level. Now, what else I can do and how I can segment my users. For example, users with low risk profile, they like take just that yield, and they additionally has to stake into some insurance pool, backstopping, vault for more risky strategies, right? And then they have that alpha, that risk premium there. But it's still, these models are much better than what we used to have before, where I don't know, you have to stake your tokens, and this token's taken out of the stable coin, and they invested in some risky strategies. The same for like on-chain native yield, right? So like a lot of things changed. Ethereum is proof of stake, right? There is a native on-chain risk-free, basically risk-free yield, which protocols can use, and which actually also unlocked Ethena, right? Because like there is part of that ability to get Ethereum staked yield there as well.
Yeah, so you only get more yield if you're taking more risk, and at some point it becomes an investment strategy, not a stable coin. So right now we predominantly see stable coins utilized on offshore exchanges for trading pairs and perps margin, and then on-chain we see stable coins utilized as supplied capital on money markets or liquidity provided on DEXs. So outside of those things, what new and promising areas are you optimistic that we'll see, I guess, new use cases for stablecoin utilization that haven't necessarily been explored yet?
Yeah, I think trading pair is still the dominant product market fit, and it has been for in the crypto industry. When you look at especially USDT, right? You know, people kind of shit on USDT for, I don't know, like how long history of like not US compliant and all these, but they've been such widely adapted, especially in like a lot of the emerging markets. And like chain like Tron, which we don't really talk too much about in US or at Permissionless, but it's like widely, like crazy widely adapted in those regions with actual utility and volume. So I think those will kind of continue to happen. On the other side of the use cases, you know, I think obviously the AI was a big topic during Permissionless. You know, there's so many things that AI agents and the protocols that are building. I'm based in San Francisco, and I talk with the AI guys, and I just like whenever I hear their vision architecture, I just can't stop thinking about, oh, these things could be easily smart contract automated and also used by stablecoin in the middle, or like how we think about key management around agents, how do we use these accounts. So there's so many ways that we can get creative, but I think today the dominant and the obvious big market opportunity is in that trading and USD stablecoin around kind of RWA and usage. So I think we'll continue to see that dominance, but as I said, the crazy students behind the scene that don't show up to class, you know, they will bring these kind of crazy ideas on how to utilize stablecoin in specific manners. So I'm quite excited that we're going to see stablecoin in all across industry, like entertainment, gaming is big, and others. So even within our portfolio, we're working very closely with many of the sectors that are different vertical to test, you know, what we can start small and then implement others. Yeah.
I still think something that hasn't happened that we tried. So you guys remember Libra and Diem, the Facebook initiative that got shut down. I still think a stablecoin backed by a basket of fiat currencies in some proportion that actually takes the edge off of being fully dependent in the United States, and it's sort of like this or a basket of assets that just manages itself. I think that's still a really cool idea. I don't know if it's going to happen or not, and for it to happen, somebody massive with massive distribution would have to come in and like force it to happen with big enough conviction. And obviously, every country would hate it. And how do you decide on which percentages? And that was a big deal at Libra and Diem, like discussing which percentages of which asset. There was lots of politics around it, as you'd expect. But stuff like that is still pretty cool. The way that I think about this is I think about stablecoins as tokenized assets, right? They're on the continuum of RWAs. Stablecoin is a tokenized dollar, period. And then yielding stablecoin is a tokenized dollar with some kind of reward. And then you kind of like go, and there's no difference between that and a tokenized security. That may also have a yield as a dividend, but also has a representation of one-to-one of some share on DTCC. And if you start thinking about it as a continuum, I do think that there will be lots of innovation and cool things that will come. But this is why I'm an investor, so I can meet founders much smarter than myself to come and pitch things that are cooler. And so I'm here for it.
Yeah, just to add to that, obviously, why this stablecoin sector is hot, everyone understands that's the really good product market fit, right? So speaking about what should increase on chain, all real world use cases, payments, remittance, any application which touches user funds, like crypto related or uncrypto related, now is able to take these funds in stable coins and like maybe get some yield back, issue its own stable coin, reward users using that risk-free rate. And this is like the optimal use case we are working for. And again, from engineering perspective, I see it like for more than 10 years, we were working on infrastructure. And we have a perfect infrastructure now to serve use case. Like in meaning infrastructure, I mean Ethereum, blockchains, Solana, like super fast, distributed, decentralized, like stable coins, programmable money moving around this 24/7 infrastructure. I think we are ready to now serve the real use cases, and they should grow.
How can we finally unlock the payments use case? I might have this utopian idea where 10 years from now, all of my commerce is stablecoin denominated. But how do we actually get to that end state? And does the infrastructure need to be built by startups, or does it really come down to incumbents integrating the solutions?
The incumbents dominate payments. I doubt that it's going to be a mode of which, and by the way, when we say incumbents, we have to realize right now that there's big startups that are incumbents, right? There are players that are incumbents that behave very much like startups and are big. I would say that anything above $50 billion of valuation can't in any remote sense be called a startup or a challenger, but yet there's many fintechs above $50 billion that are willing to innovate and that are already within the system, Stripe being one of them, Revolut being another one, all of these. So I do think that those are going to be, what is it, Stripe has over 1% of the world's GDP in terms of payments volume, and they already accept USDC as a legitimate payment mechanism. And so, you know, we're off to the races. If there's a way to incentivize USDC or USDT to be accepted, these stablecoins to be accepted directly, we'll see, but we don't need it to happen for stablecoins to be successful. And again, I think stablecoins right now have found product market fit, but have found product market fit specifically on anything that touches a border. If it touches a border, a stablecoin has an inherent advantage, and there's tons of amazing RTPs on all the countries. And in fact, we have countries doing cross-country RTPs for which stablecoins don't really present themselves that much of an advantage. The programmability doesn't demonstrate themselves superior, and it's harder to replace something that works already so well.
Yeah, you know, I think all Diego said was, you know, I think it's going to happen. I think for me, something that's kind of interesting that may happen is there's a shift in position, I guess, placement of your cash that's happening through stablecoin. Because if you own stablecoin in dollar form rather than having your banking account, checking account in Chase, you don't really need to have majority of your assets at a bank anymore. You know, it might actually be multiple different places. Just like how, let's say, like, as I was growing up, I think Venmo was kind of a big thing that I used with friends, and Venmo started accumulating dollars on the account rather than sending it right back to my bank, so that it became kind of like a wallet itself, and I can pull money out from that directly and then use it for something. And then they even put friction on, you know, moving dollar from Venmo to my banking account, like 3 days or something. If you want to do faster, pay some fee. So there's no friction that will stop you anymore to be in the bank, to be in Venmo. That means based on your goals of financial activity or whatever your kind of economic activity you're doing day to day in terms of payment, where you have your cash might actually completely change than where we have today. Because usually people have 1 to 2 banking accounts, savings account, and use from that. But maybe I will end up with like 10 different places with my sizable dollars that I use for different purposes. Might be in different stablecoins, same stablecoin, doesn't matter, right? Maybe my gaming account might have like, I don't know, like sizable amount that I never had in banking account before. So how would banks cope with that, because I think they're quite scared, and that's why they're being very active, because it will completely change how retail manage asset placement in the future. And my thought is that our fund invests quite heavily in consumer, not just layer ones and infrastructure. And one of the theses is that maybe the kids growing up right now, the first economic activity they will do is through wallet, not through bank. It's like first thing I remember growing up in US was like, oh, go to Chase and make this debit card and then make a credit card so you build a credit, so that you can buy a house or, car down the line. But now the kids growing up, maybe they're playing mobile game, it has a wallet, it has stablecoin. That's where you have your net worth as a kid. And it will grow as they grow into having economic activity. It will completely be different how they utilize their asset and position or even the yield, right? So I'm very fascinated about this change. I'm very excited. And I think there's going to be a lot of good venture opportunity to be creative about that movement of asset position by massive people around the world.
Yeah, just to add to that, like what we need to see for the payments use case to be unlocked, I think we already see it's happening, just like following Stripe acquisitions, right? Like how pieces are getting in order. So first of all, like what we need on-ramps, off-ramps. I mean, overall it exists, right? It's obviously location dependent, but it's present. Then to unlock use case of stablecoins, users and retail users need to have easy wallet as service infrastructure, ideally obfuscated for them, ideally for different chains, right? And like some kind of interoperability between stablecoins and liquidity management. So like Privy, wallet as a service acquired by Stripe, like kind of shows what's happening. And then as coming to the previous topic, we have the best infrastructure for payments, which is blockchain itself, right? So it's 24/7 decentralized, fast, cheap, depending inexpensive, depending which L2 of EVM we're talking, or Solana. So we have all pieces in place. I think we'll see unlocking very, very soon.
So Diogo, previously in the talk, you were bullish dollar dominance in the stablecoin market. And certainly the data reflects that, with 99.9% being US dollar denominated. But Baek, previous to us hopping up on stage, you were mentioning developments you were seeing on the international front where other foreign currencies might be leaning into stablecoin issuance as a way to strengthen the utility of their own local currency. So what are you seeing develop on that front?
Generally, hard money, chases away soft money. And so it doesn't really matter what these countries do. It's all about consumer demand. And unless they mandate that their local citizens have to hold something, then they don't really have a chance. And so it really has to be dollars loss of dominance and some other currency rising as a potential alternative that dictates the outcome of the stablecoin issuance. There's no way that otherwise this will actually be. In fact, I'm surprised that euro has zero representation. You'd be expecting euro to have some representation, but it basically has zero representation. And of course, like with Mika, as usual, we shoot ourselves in the foot, but generally has zero representation. I would expect some amount of correlation to the dollar dominance in trade to sort of translate to the dominance in stables, because that's sort of roughly a mental model that makes sense. But otherwise, it has to be the geopolitics playing out. And there's nothing that a country can do independently to somehow have their stablecoin succeed if they don't have the fiat currency succeed.
Yeah, I think one story that I can share that's a bit more specific to local government or local citizen is local stablecoin. That's been a big agenda in, I think, a lot of the countries. US is a bit better than most of the countries because it's quite evenly distributed in terms of big city innovation and the companies. But most of Asia or other countries are very much like they're struggling with the concentration of population, talent, and industry in capital cities. And everything around it is just kind of dying away with losing population every year. And the industry is moving away. So usually when that happens, governments bring out incentive programs to give cash or bonuses to businesses or retail or even people to spend it in local economy so that it creates a kind of positive feedback loop of economic activity to grow. But what happened usually in these kind of cases in Korea, Japan, and a lot of these countries that are struggling with this, they get their money and they go to big city and buy shopping at the big city. Go back to Tokyo, go back to Seoul. For example, here, like you might be getting money from out of West Virginia, but you actually go spend money in New York City. So that's been a big issue in terms of kind of evenly growing the regional economy for many countries. So stablecoin can actually become interesting alternative for them that it's only used in specific kind of a section or shops or use cases, kind of like EBT in US, but more regional specific than the class or purpose specific. So I think those are also kind of interesting things that we will start to see with being utility money future on, rather than just capital formation around stablecoin and digital asset.
Great thoughts. Thank you. Unfortunately, we are up on time for this panel, but absolute pleasure. Thank you to our speakers, and thank you to our attendees for coming by.